What's up, guys, and welcome back to Wall Street Millennial. The House Financial Services Committee's hearing with the CEOs of Citadel, Robinhood, Melvin Capital, and Reddit, as well as Keith Gill, aka Roaring Kitty and Deep Effing Value, is turning into the main story of this week at least. On February 17th, Robinhood CEO Vlad Tenev submitted his prepared remarks to the committee. In it, he makes many claims that of course are aimed at confusing the committee and generating sympathy for himself and Robinhood. Importantly, there is a subtle but incredibly important inconsistency in his case that obfuscates what really happened and shifts blame from Robinhood onto the financial system. In short, he blames the trading restrictions on the way that trades settle rather than on the shorts being on the verge of bankruptcy, and refuses to explain exactly why restricting buying and not selling of Gamestop stock was the only solution. In this video, we're going to review the key points of the testimony, distilled into one short video, so you know everything you need to know about what Robinhood is bringing into the actual hearing. First, he opens with a completely irrelevant account of his supposedly humble beginnings as an immigrant and a feel-good story of a rags-to-riches family. He says, "I was born in Bulgaria, a country with a financial system that, at the time, was not accessible to ordinary people and was on the verge of collapsing. I immigrated with my family to America for a better life when I was 5 years old, and my co-founder, Baiju Bhatt, is the son of immigrants. Robinhood's mission to democratize finance for all has a special meaning for us. My parents, both of whom worked at the World Bank, instilled in me at a very young age the values of financial responsibility and opportunity for all. And those values lie at the heart of Robinhood today. We fundamentally believe that participation in U.S. capital markets is empowering and that everyone should have the opportunity to participate responsibly in our financial system." Next, he continues with an account of what Robinhood is and does. He says, "Today, however, approximately 84% of the value of all stocks owned by Americans belong to the wealthiest 10% of households. And roughly half of all American households do not own any stocks at all. We want to open up access to the market so everyday people, even those with small amounts to invest, can build wealth. We started by eliminating commissions and minimum investments, and we continue to pioneer changes that democratize finance for all, such as fractional shares and recurring investments. Further, we subscribe to the belief that participation and information are power. We provide simple, easy to understand, and easy to use tools and educational resources that are not filled with complex industry jargon. This helps support customers from all backgrounds in their investing journey. Our rapid growth has confirmed that retail investors were waiting for the right platform to help them enter the markets. We have over 13 million customers, and we are seeing new customers open accounts every day to take part in our financial markets. Robinhood Financial's customers trade thousands of stocks and ETFs, as well as options and cryptocurrency, all with zero commissions and no account minimums." He then tries to defend the accusations that have been made of Robinhood promoting reckless trading, especially for inexperienced investors. These allegations stem in part from a recent case from last year, in which Robinhood user Alex Kearns committed suicide after seeing a huge negative balance on its Robinhood account. He said in his suicide note that it is ridiculous that a 20-year-old could be eligible to get nearly $1 million of leverage without knowing and lose it all. It turns out that the negative balance was not real, but instead caused by a defect in Robinhood's systems. Vlad says about this issue, "Importantly, there are some activities and products that are not available on Robinhood. Robinhood does not offer certain products that may carry a higher risk profile, such as uncovered options contracts and over-the-counter bulletin board stocks. Robinhood also does not allow short selling on our platform." Overall, as of the end of 2020, about 13% of Robinhood customers traded basic options contracts, for example, puts and calls, and only about 2% traded multi-leg options. Less than 3% of funded accounts were margin-enabled. We also recently made several changes to our options offering. For example, we improved our options educational materials and hired a dedicated options education specialist to support our continued education initiatives. We made changes to our app interface to include more safeguards and information, added the ability to cover early assignments in-app, and strengthened the eligibility criteria for new customers seeking to trade certain types of options strategies. We invested in growing our customer support teams and began offering, among other things, phone-based customer support for options traders. So basically, by paying someone to write a couple articles on what a call option is, they think that they can encourage inexperienced new users to effectively gamble on a system that is also defective, continuing a lucrative practice that caused Alex Kearns' death. Vlad also defends Robinhood payment for order flow. As stated, Robinhood is not unique in receiving payment for order flow. Annual reports show that Charles Schwab, E-Trade, and TD Ameritrade all received significant payment for order flow revenues in 2019. It is important to note that Robinhood's payment for order flow relationships are with market makers and not with hedge funds. Robinhood Securities regularly evaluates counterparties and routes customer orders to those market makers that can provide the best execution quality on those orders. It's true that payment for order flow is a common practice among brokerages. What people may not know, however, is that Robinhood's order flow is so profitable to market makers that they are able to charge significantly higher rebates from market makers than other brokerages are. Although price improvement does benefit the end user, the majority of the gains go to the brokerage and to the market makers in the system. After this, Vlad gives his explanation of what led them to restricting GameStop buying. At approximately 5:11 a.m. Eastern Standard Time on January 28th, the NSCC sent Robinhood Securities an automated notice stating that Robinhood Securities had a deposit deficit of approximately $3 billion. That deficit included a substantial increase in Robinhood Securities' value-at-risk-based deposit requirement to nearly $1.3 billion, up from $696 million, along with a, quote, excess capital premium charge of over $2.2 billion. SEC rules prescribe the amount of regulatory net capital that Robinhood Securities must have, and on January 28th, the amount of the NSCC VAR charge exceeded the amount of net capital at Robinhood Securities, including the excess net capital maintained by the firm. Under NSCC rules, this triggered a special assessment, the excess capital premium charge. In total, the NSCC automated notice indicated that Robinhood Securities owed NSCC a total clearing fund deposit of approximately $3.7 billion. Robinhood Securities had approximately $696 million already on deposit with NSCC, so the net amount due was approximately $3 billion. Between 6:30 and 7:30 a.m. Eastern Standard Time, the Robinhood Securities operations team made the decision to impose trading restrictions on GameStop and other securities. In conversations with NSCC staff early that morning, Robinhood Securities notified the NSCC of its intention to implement these restrictions and also informed the NSCC of the margin restrictions that had already been imposed. NSCC initially notified Robinhood Securities that it had reduced the excess capital premium charge by more than half. Then, shortly after 9 a.m. Eastern Standard Time, NSCC informed Robinhood Securities that the excess capital premium charge had been waived entirely for that day, and the net deposit requirement was approximately $1.4 billion, nearly 10 times the amount required just days earlier on January 25th. Robinhood Securities then deposited approximately $737 million with the NSCC that, when added to the $696 million already on deposit, met the revised deposit requirement for that day. Here's where a very important point comes up that most people will miss. First of all, he says nothing about Robinhood lending out shares to short sellers behind the back of Robinhood's users, which they almost certainly do. Of the $3.5 billion of capital requirement imposed on Robinhood on January 28th, the majority of it, or $2.2 billion of it, was excess capital premium. Only $1.4 billion was value-at-risk capital, or the capital that enables the 2-day settlement period. Robinhood was able to put up all the value-at-risk capital before the market opened with no problem. The only problem was the excess capital premium. Vlad purposely did not go into detail of what excess capital premium is for, but based on the account of Interactive Brokers chairman Thomas Petterfy, it is pretty clear that this is capital that's put up by brokerages in case short sellers go bankrupt. Brokerages lend out shares from their own customer accounts to short sellers for a fee. If short sellers cannot repay their short obligations, brokerages are required to make up the difference by buying the stock at any price on the open market to return to their customer accounts. The excess capital premium is almost surely largely for in case that happens. If the brokerage is not able to make up the difference, then the losses are spread throughout the clearinghouse system. So basically, the majority of the $3.5 billion of capital requirements was to guard the clearinghouses against incurring losses if short sellers and thus the brokerages go bankrupt in a domino effect. Because the suppressing of buying of GameStop stock, but not selling, artificially pushes down the price of GameStop and allows the shorts to cover, this risk is mitigated. This is probably the reason why the clearinghouse waived the entire $2.2 billion collateral requirement after Robinhood announced the GameStop ban. Instead of explaining why this market manipulation happened, Vlad obfuscated by blaming the settlement period instead. Here's how he did it. As previously described, it takes the trade date plus 2 days for an equities transaction to be cleared and settled by a clearinghouse. During this period, the buyer and seller of the security must post collateral with the clearinghouse, and the clearinghouse may require an additional deposit as excess collateral. Clearinghouses look at the firm's unsettled equity trades when determining how much collateral is required. Clearinghouses look at a number of factors, including volatility, when looking at specific stocks in order to quantify risk and may assign additional charges based on how many unsettled trades there are of one stock. Additionally, if a firm's customers have more buy than sell orders, and the securities they are buying are more volatile, the deposit requirements will be significantly higher. For example, if a broker-dealer's customers have submitted more orders to purchase than to sell a particular security, and the price of the security that the broker-dealer's customers are buying is more volatile, then the resulting deposit requirement will generally be higher. The existing 2-day period to settle trades exposes investors and the industry to unnecessary risk and is ripe for change. Every day, clearing brokers like Robinhood Securities have to meet deposit requirements imposed by clearinghouses to support customer trades between the trade date and the date that the trades settle. Investors are left waiting until their trades clear, and the clearing brokers have their proprietary cash locked up until the settlement is final days after the trade. The clearinghouse deposit requirements are designed to mitigate risk, but last week's wild market activity showed that these requirements, coupled with an unnecessarily long settlement cycle, can have unintended consequences that introduce new risks. There is no reason why the greatest financial system the world has ever seen cannot settle trades in real time. Doing so would greatly mitigate the risk that such processing poses. Indeed, real-time settlement would have allowed Robinhood Securities to better react to periods of increased volatility in markets without restricting the purchasing of securities. It's true that the T+1 settlement period makes no sense in this day and age, and it did contribute partially to the Gamestop ban. But the majority of the liquidity issue had absolutely nothing to do with this. Also, even if Robinhood had enough capital to put up and thus be allowed to keep supporting GameStop, they probably would not have done so. If the short sellers go bankrupt, Robinhood is on the hook for absorbing their losses, to the tune of more than $2 billion in this case. Because of the way the system is set up, Robinhood is able to blame the ban on the clearinghouse capital requirements, and everyone is able to obfuscate the blame. Unfortunately, it is unlikely that the House Financial Services Committee will be able to see through Vlad's tricks and understand what is really going on. Most likely, nothing will happen and the whole untransparent system will continue making billions of dollars for the brokerages, short sellers, market makers, and clearinghouses. Alright guys, that wraps it up for this video. Let us know in the comments what you think about Vlad's testimony and whether or not he deferred the blame of what was really going on. Also, make sure to hit that like button and subscribe for more updates on the hearings. As always, thank you guys so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.